Mr. Wright is finished having his lunch. Well deserved. I'd like to begin. Kevin and I are going to introduce here Mr. Sam Wright. He is from State Farm. And Mr. Wright is a very well informed, active person that really cares about everyone. And the reason he's dedicating his time here is not because he needs the business, it's because he wants you to learn. But we want to also have a reciprocal relationship with him, help him support his business as well. And I want to thank Mary and Candy, his assistants that are here to bring the food and prepare. So I want to, we gave Mary a break today. So Mary's not providing the food today. So thank you, Mary, appreciate that. But let's give them a hand of applause, please, before they leave. I want to share a fun fact about Sam. So Sam, I just learned that he was playing sports and was almost a pro sports player. I'll let him go into the details with you on that. I also learned that he golfs. We have a golfer here. We have a couple golfers here. Mark, Andy, I don't know who else here golfs. And then he also is an avid for Lords of London. Lords of London, he'll go over that with you as well. And also, he started his underwriter career with the British insurance area, in the British area. He's going to go in further detail with all of that. So we have someone here that is extremely knowledgeable, has a lot of heart, and cares so much about the industry that he's in and how to help protect us. And because we care for you, Kelvin, myself, Mark, and Mary, we want you to learn. So I appreciate you all being here. So Kelvin, do you want to add anything to
this stuff?
Sam?
Is important. Thank you, Sam, for coming here and sharing with us, because I don't know how many of you guys have dealt with your clients or in your deals, but I've heard already several transactions where buyers are kind of late on their due diligence. They failed to get their evidence of homeowners insurance quote premium on time, and they try to do it last minute after they removed all contingencies, and boom, they find out that they're denied coverage. They find out that they can't get coverage from a major provider like Allstate or State Farm or Farmers, who have exited California in 2023. They have made a business decision that it's not worthwhile for them to stay and remain in California due to a lot of different types of claims, but largely due to wildfire threats, which have devastated many areas as we see global warming becoming a true, real issue. You can see fires going on in Maui last week. Our hearts go out to all of those victims who have over 100 families and individuals have passed away. And it can happen here. It can happen in our own backyards, especially when we're surrounded by the greater San Gabriel Mountains and the foothills areas have high fire insurance premiums. Many of you seen them double or triple in their premiums over the last several years. And that is a large burden on many of us normal homeowners, right? And our clients. So what do we do? What are our solutions? What do we do when a lot of the what's called the major providers are leaving? We need to be here as agents to be problem solvers. We're solution providers, right? So learn, ask questions, soak up information from Sam and his State Farm, because I also have State Farm coverage. And there's a lot of different things and aspects about, yes, we don't have to know everything about the deal, but we need to know where we can find those right answers and solutions and where we can get coverage. So without further ado, I hope you're not in a situation where you failed to obtain your quote premium early enough. Do it during your 17-day due diligence period. Why? Because also a benefit we found with another buyer I know is when you do that, you are also able to discover if there were past water leak claims on that property, because some insurance providers will say, oh, I can't give you that quote. There's 2 claims in the last 5 years. And then they deny coverage. So that allowed our borrower to question things, to renegotiate or cancel that deal during their legally entitled rights to the contingency period before finding out that they can't obtain insurance. Because that is a requirement from your lender. And if you didn't get that and you removed all your contingencies, you're in a pickle. Okay? Sam, tell us what we're going to do. Thank you so much for bringing the Chick-fil-A Very classy.
Very
We all
classy.
enjoy it. Welcome aboard.
Thank you.
Well, the first thing I'll say is, I'm happy to be here. And, that fun fact that I told Sylvia about, me starting insurance with a British company, means that I'm steeped in British knowledge of insurance. Lloyd's of London is what I know an awful lot about because I studied the history of it. The Brits are very proud of Lloyd's of London because it was the cradle of insurance, right? Much like the cradle of the insurance knowledge, and everything that became insurance started there. So, yeah, I was fortunate to be able to work for a company like that and get the basic background, because it kind of shaped who I am today, and it shaped my base knowledge and gives me a lot of broad knowledge. Now, what I'm gonna, well, I'll get to what I'm going to talk about today. But first, I'll say, in addition that my background being there, I've owned a state farm agency in Monrovia for 30 plus years. I am a member of the chamber there and other places. And I'm a Rotary member, past Rotary president. In fact, I just spoke to the Rotary Club on Tuesday because this is such a significant event that we're seeing. And I'll get to that in a minute. But I'm a past president of the Rotary. I'm a member of affiliate of AAR. And I love AAR. In fact, I love generally all real estate agents, especially those, as you know, everywhere I go with real estate agents, I find the associations are always giving back to the community. That's an item after my own heart. This is something we have to do as small business people. We have to give back to the communities that we sell to, and that's an attribute of an admirable business and people who are thinking correctly. We must give back. We can't just take. You got to turn around and give back. And real estate agents almost always do, and that's why I support Arcadia Real Estate Association so much, right? I also am a member. I also have provided scholarships for. I'm with a group, started a group that provides scholarships for disadvantaged kids, probably the last 20 years or so. And we seek these kids out and we provide mentors to them and try to help them become. They're usually kids that are wavering a little bit on the brink of falling off of a cliff or just becoming bad people. The more good people we can save from being bad people, the better off we all are, because they wind up contributing to the economy and maybe wind up buying a house from one of you, right? And instead of winding up in somebody's jail or something like that. So the more things we can do, like I love doing things like that. All right, so that's enough about me. So I'm going to get into a serious subject because we've never seen anything like this. Honestly, we've never seen insurance companies doing what they're doing right now. But before I start that, that's a very serious subject. I'm going to tell you a little story. This story is about a man and his wife and mother-in-law. They're in Israel. They're in the Holy Land. They're visiting. And while they were there, the man's mother-in-law passes away. So they're in the Holy Land. Mother-in-law passes away. So he's got to do something about that right away. One of the higher officials in the Israeli government said, listen, we can bury your mother-in-law here, or we can have her, sent back to the States. Cost $150 to bury her here. And, it's a good deal. It costs you $5,000 to send her back to the States. What do you want to do? The husband says, well, I want to send her back to the States for $5,000. They were shocked about that. So next day they asked him again, which the offer still stands. I mean, you're in the Holy Land. Your mother-in-law could be buried in the Holy Land. Why wouldn't you not take the $150 and pay $5,000 to send her back? His reply was, 2,000 years ago, a man over here was raised from the dead and walked out of a tomb. I do not want to take any chances with my mother. No, all right. I know, see, I had you going, didn't I? I had you going on a serious subject. All right, so listen, mother-in-law jokes are, I'll say for one, I love my mother-in-law. She's tremendous, but not all people do. Yeah. Anyway, so here we are. Serious subject. Never seen anything like this. Never seen it. We've seen pauses. We've seen, just little pauses, maybe 3 months, 6 months, something like that. But never seen a situation where insurance companies are saying, A, we're not going to sell business, new business in California for the time being until further notice. State Farm did that back in May, and then boom, one by one, here comes everybody else. And that's typically what happens. State Farm is the largest writer of homeowners insurance in California. So if the largest writer does that, then everybody starts bailing out a little bit at a time. And it's for a number of reasons. And I'm gonna get right to it and try to figure out what it is we can do to try to, well, first of all, you gotta get these escrows closing. You gotta have a method of closing them. And we figured out a way to do that. You gotta close the escrows. We cannot have an insurance industry collapsing in on a real estate industry because all of a sudden, you guys, you understand how important you are to the California economy. You are that important to the California economy. We cannot have an insurance industry collapsing, and then all of a sudden, we got a situation like we had in Florida a few years ago. Florida has already been through this, and we sit and we watch, and I just don't want us to become another Florida. I do not want California to do that. So I'm going to try to give you the background on it so that, I think once you understand why it's happening and understand insurance companies and the way they think differently. They do. But once you get that part down, then you'll get what it is we probably need to do to hold each other up. Because let me tell you something, we're all in this together. I'm here with you, you're in with me, and we got to figure out something, figure out a way to keep this going. All right, so we'll start. So we start with, how did we get here? Well, for a lot of years, we just had dwindling numbers of insurance companies who were just not willing to write in the brush or even adjacent to the brush. Well, it started out with not writing in the brush. Then you had places like Bradbury, Upper Monrovia, Norumbega, Briarcliff, all those areas. Then you had Upper Monroe, Arcadia, all up in the hills of Arcadia. Then Kenneloa Canyon. So those are the major brush areas. Well, of course, you got Duarte Mesa too, which is right on the very top. So one by one, though, people started dropping out. And it was concerning. It'd be concerning to any other insurance company to having less competition, because you really, believe it or not, they want that competition too. Insurance companies seem like they would love to have 100% of the business. They don't. They'd be scared to death if they had 100% of the business, because they know that if they're going to get their numbers correct, their actuarial numbers correct, they don't want too big of a percentage. They need the competition to give them the selectivity. So the competition has to sit on a stool and say, actuarially, can we choose the best risk? Can we be the choosers of the best risk? So they don't want that. So one by one, as people kept falling out, we finally got, well, let's see, where did it started with the larger carriers like who insured large homes. So like in Bradbury, Chubb was one of the larger carriers. Farmers Fund was one of the larger carriers in Bradbury. And they gradually started saying, okay, we're not gonna insure these high value homes anymore. So they left that to One by one, they kept dropping out. Same thing over in Kinaloa Canyon, same thing in Monrovia. And one by one, they kept pulling back. That left just a few companies. It left, and I'm talking about a few years ago now, it left Allstate, State Farm, Farmers primarily. Allstate dropped out about 10 years ago, and they came back a year ago and then dropped out again, you know, because they said, listen, we just can't handle that California market. And then here we are today. State Farm announcing they're not going to write any more new business. So now what? Now what do we do? Well, I'll back up and tell you, I said we don't want to become another Florida. Let me tell you what the things are that we have in common with Florida. First of all, we have catastrophic events. They have hurricanes. We have wildfires. Hurricanes are much worse, but wildfires are getting to be pretty doggone bad. Just ask the Canadians this morning as they're dodging wildfires. Ask the Hawaiians in a place where I spent my honeymoon. I just it pains me to see that little whaling village completely leveled, completely. So if we're going to be in a position, to hold the insurance market together, we're going to have to do some different kinds of things. So what's causing it? So we understand how we got here, but here's what's causing the rise in rates. You've seen rates from these insurance carriers, no matter who, starting to skyrocket, right? One of the major reasons is the cost of reinsurance. So now back to the commonality between California and Florida. We have about three things in common. Once again, I said hurricanes and then wildfires. So secondly, they are a litigious state, and we're just as litigious as they are, just as litigious. They also have a tremendous amount of fraud. They know about it. We also have a lot of fraud in our system. So those are the things that, start to, things that you don't think are going to impact an insurance company, because they got all the money in the world, so we think, but apparently not if they start getting hit by wildfires left and right. I'll give you an idea of some minor fraud. That's happened to me before. I had to go running out of the building. I'll give you some examples of things that, every time we had a fire area, a fire come up, boom, here and there, upper Monrovia, Kinaloa Canyon, that kind of thing. Every time it happened, you would always get a group of people getting letters from an attorney saying, listen, you were adjacent to this and this and that fire, and we know that you have smoke damage. You have smoke damage that you don't realize you have. Well, yeah, there'll be some smoke damage that creeps in. So they send you out this letter and they say, we can probably get you around $20,000 or so, $15,000 to $20,000. Because I used to have my clients call me about it, and I'd say, well, you can take that, I guess. They're going to take a good portion of it. The lawyers are themselves. But if I were you, I wouldn't do it. And there's one reason I wouldn't do it. I believe, here in smoke damage of that sort is never, it doesn't stay. It kind of clears itself out. And of course, these guys know that, and everybody will know that. If you take it, I'll say you can take it, but caution, nothing is ever free. It just isn't. Sooner or later, it'll wind up costing you in some way. And those kind of claims, I mean, if you have a number, let's say you got a number of $15,000 net, 50 or 20 or $15,000 claims piling up, that's a lot of money, and then those kinds of things is what drives the cost of reinsurance up, right? Okay, so we're talking about the skyrocketing cost of reinsurance. Now, let me tell you what reinsurance is. Reinsurance is a concept that came through the British insurance market. Most of the reinsurance companies are foreign companies. biggest reinsurance company I know is a French company. And then the others are British companies. US has not that many reinsurance companies, but what do reinsurance companies do? They insure insurance companies. So an insurance company has, well, I'll give you a good example. Golden State Bridge is one big giant item. You think one insurance company handles that? No. One insurance company, 2 or 3 insurance companies will be on it, and they will take a section of the bridge and they'll insure up to a certain dollar amount, and then they'll ask for reinsurance to go from that dollar amount up to another dollar amount, and then they'll turn around and ask another reinsurance company to take the excess over the top. That's how it works. There's no one insurance company that can insure the Golden State Bridge. There's no one insurance company that can insure the George Washington Bridge or the Throgs Neck Bridge. If you know anything about New York, you've heard of those bridges. No one insurance company can do it, so they have to get reinsurance. Well, hurricanes and wildfires have now reached the point where they require reinsurance. They didn't require that much reinsurance before. So the reason for the skyrocketing prices I'm talking about is because the cost of reinsurance is going up. That's a quick lesson in reinsurance. I could go into it a whole lot more. I used to negotiate reinsurance contracts. Okay, so what's the other issue here? We got an awful lot of regulation in California. That's the other similarity we have with Florida. They were highly, highly regulated. And the reason I say we don't want to become like Florida is because regulation in Florida ran insurance companies out. Eventually, it not only ran insurance companies out, but it caused several of them to go belly up. The smaller insurance companies went belly up because they could not get enough premium, actuarially speaking, to handle the exposures they had. We got the same thing. California Department of Insurance is highly political. They and I'll say this for them, they do protect consumers. And I don't mind that. But I do mind it if they hold down rates so much that they're in danger of running insurance companies out. And we're at that point right now. We're on the edge of that. So we've got to sit there and say, okay, what are we going to do? Let's talk about what needs to be done to try to hold this situation in place so we don't become another Florida. Well, what we have to do, is, you see I've got up there, snail's pace on rates requested by the California Department of Insurance. So insurance companies request rate increases. First of all, they chop them down, say, no, you don't need that much. We'll give you this much. And then they slowly give them the rate increases. Well, actuarially speaking, all the reasons that they had for asking for that rate increase, the actuarial numbers, by the time they actually give them the rate increase, the actuarial numbers are out of date, right? So they're steadily behind, they're slow giving them the rate increases. So I'm gonna mention a really fun fact as a result of that. That's number 4, California homeowners premiums compared to the rest of the nation. So I'm going to state one simple fact. As a result of overregulation, California homeowners premiums are below the national average. I know that's shocking. I see shock on your face, but I'll say it again. California homeowners insurance premiums are below the national average. And it's primarily because of a little overregulation. So what's going to happen in order to get insurance companies back into this market is we're going to have to pay more for insurance. Florida has the highest insurance rates in the nation, and they were highly regulated. We're well below Florida. We're well below Louisiana. We're well below Texas. You know, Texas has got the Tornado Alley up near Wichita Falls. I'm from Texas, so I know all about diving in the holes and getting away from twisters. So let's think about it for a minute. You got a house in, I don't know, you got to say 1,200 square foot house in a 1,300 square foot house in Arcadia. You take that same house in Wichita Falls, Texas, will cost more money for insurance than the house in Arcadia, California. That's odd, isn't it? Especially since the market value of the 1,200 square foot Arcadia house is about 3 or 4 times that of the little Wichita Falls, Texas house. There's something not quite right about that. That's out of whack. So that's kind of, that's kind of where we are. Now, market value doesn't equal insurance value. Insurance value, of course, is replacement cost. But if you're going to do replacement cost to replace, then you're going to get the market value, especially since it's new construction, right? So I'm saying everybody knows there's something a little bit out of whack about this. So what do we do? Well, I was in on a group meeting with the Department of Insurance, the insurance commissioner, Mr. Lara, and it was not just me. Of course, it was a group meeting. We're all on Zoom, and it was an interesting meeting. I got to tell you, it was really interesting, and there were some great ideas they came up with. I'm going to read you 2 or 3 of these there's 4 great ideas. Have insurers be given credit for reinsurance costs. Remember, I was just harping about reinsurance and that being a major cost that's figuring into, because they pass reinsurance cost alone. So have insurers be given credit for reinsurance costs. Well, that would do it. It really would do it. 2, receive a cost of capital for wildfire risk retained. Now, I know State Farm would really love that because they insure more in the brush areas than anybody else. But every insurance company will love that if they could get something like that. 3rd thing, be allowed to use prospective rate models. I mean, they're agents and brokers are always putting together rate models. You're sending them to the Department of Insurance. Nobody's ever going to take those. We understand that. And the 4th one is to receive expedited rate change decisions. Now, if they could just simply speed those up, I already said before that once they get around to actually giving a rate increase based on actuarial numbers that were done last year, by the time they get around to doing it, the actuarial numbers are no good. And then an insurance company will turn around and say, okay, we need another 6.5%, 7%. So it keeps going on and on and on like that. And I can tell you that any one of those things that you just saw were implemented, especially the reinsurance. I think we get back in business just like that. But unfortunately, it's highly political, very highly political. So we've got to wait and see what's actually going to happen. So, as I said up here, all of them would be a pipe dream and would quickly get all the companies. I would say several companies. I'm going to say all the companies would come back into the market. I'm really hoping that something can be worked out on number 1 and number 2, especially the reinsurance. Commissioner Lara has the power to enact 1 and 2, but too political. He's not going to do that. California is a consumer-oriented market. He's just, if he's got extra political ambitions, then he's just not going to do that, because it'll hurt him. So where do we go from here? So I'm going to get to what we need to do now that you've got some idea, about how we got to where we are and what's causing the problem. What do we need to do? We need to stabilize the market. Well, California Department of Insurance can make some moves and help stabilize the market. That's for sure. What can the consumers do? Well, for one thing, if you got current homeowners insurance, stay put. Do not go anywhere. Do not try to go and try to get a competitive quote. And for God's sakes, pay your insurance premiums on time, because there are companies out there, the minute you are a day late, you're $1 short. they won't reinstate you. They've suspended, many companies have, State Farm hadn't done that, but there are many companies that have suspended the rules for late pay. You know, no grace period. They're suspending grace periods, taking that away. So do not wait. You know, if you're just a chronically late payer, better change your habits really quick, or give the responsibility to somebody else. With the rising insurance premiums, here's what I'm going to suggest you do while we're trying to figure out the problem. You're going to have your insurance rates are going to be going up. Everybody's rates are going to be going up because I just said it's a snail's pace and they're always behind. Well, I can tell you that despite the fact that everything's on a pause right now, that the rate increases are going to keep coming because they're about a year and a half behind, right? So don't be surprised if you see rates suddenly still continuing to rise. I said, well, wait a minute. Why are rates continuing to rise when nobody's writing business? Well, these are things that are already in the pipeline or just slow coming out. All right. So what I would say is this. Here's a way to combat rates. And this is something in general that we're going to have to think differently about. We have to think differently about deductibles and the kind of deductibles we carry. You're going to have to consider taking deductibles up. Don't sit around with a $500 or $1,000 deductible any longer. Take a little bit more self-insurance. And I'm going to say, you know, just for regular homeowners, I would say $2,500. I'd go to $2,500, maybe $5,000 if they can afford it. And for those of you that can't afford it, that means you're probably in one of those super houses. Get your deductible up to $7,500, $10,000, $15,000. I would take self-insurance any day and try to hold that premium down until we get this thing figured out. I think I'm suggesting that to a large quantity of my clients that I know can afford that kind of thing. I've already had some people take $20,000 deductibles. They'll say, "The heck with that, I can take care of it." I'm not looking for a small claim anyway. I have discussions with my insureds, and they'll say, "Well, looks like it's going to be about $5,000 this claim. You know, maybe the guy's got a $2,500 deductible." And we discuss it, and he'd say, "Well, what do you think?" I said, "If I'm you, I wouldn't put the claim in." I says, "Okay, why?" The reason is insurance companies always react to small claims, and that would be a small claim. He'd only net $2,500 out of it, right? So it's a smaller claim. So you could have, well, I'll give you an example of how insurance companies think, because I've been on the inside. You could have 3 claims, 2,000, 2,000, 2,000 in different years, 3 different years, total 6,000. And then you'd have 1 claim for 100,000. Guess which one I'd get the letter on? The 3 claims for 2,000 each. Nobody would say anything about a $100,000 claim because a catastrophic claim is expected. That's expected in the actuarial numbers. And they, you know, when they say that, and they say, okay, well, these actuarial numbers actually expect once in a while somebody's going to have a major claim. So nobody's going to say anything about that. But they don't like frequency. If you start putting in, so the reason I discuss claims a lot with some of my people is so you don't wind up with something that looks like frequency. So taking the deductible up will solve 2 things. It solves a frequency problem, or what looks like a frequency problem, and it holds down on your premium. All right, everybody got that part? Okay. Now, here's a big subject here. Watching the carriers in the market. Now, right now, we've got virtually nobody offering new homeowners policies. So we've got 2 types of carriers. We've got admitted carriers and non-admitted carriers. And if you do have somebody that's offering, you're going to have to figure out whether they're an admitted carrier or non-admitted carrier. So Sam Wright, please define admitted carrier. An admitted carrier is somebody who is licensed to do business in the state. In order to get that license, they have to put up a certain percentage of their net worth and hold it in sort of an escrow fund. It's generally around 25%, so that if things go badly, they have this money sitting in a fund. A non-admitted carrier will be someone who is not licensed to do business in the state, exactly the opposite. And they come about through brokers who are out. They come from somewhere like Arizona. They'll be domiciled in Arizona. They'll be domiciled somewhere else. They come through a broker and they'll walk in and say, yeah, we might take a look at that. We might take a look at that for a price. Then they do that. But what's the difference then between a non-admitted carrier and admitted carrier? Okay, so we know one is licensed and one is not licensed. Here's what the major difference is. And I'll drop down to number 3, CIGA, California Insurance Guarantee Association. The non-admitted carrier is not a member of CIGA. Admitted carriers are automatically members of the Guarantee Association. If one of those companies, if an admitted carrier goes belly up, CIGA pops in and says, okay, we're gonna take care of this claim with a company that went belly up. That's the advantage of an admitted carrier. A non-admitted carrier can, while they can sit there and make all kinds of promises, and you know what, they may very well, they may be okay for some things, but I would say not in a market like we have right now, not for homeowners. A non-admitted carrier can simply walk away. They have no obligation to the state. I mean, you can try and come after them, but you know, if they say Chapter 11, well, then you're out. You got nothing to go to. You can't even go to the state of California to a guarantee association and get up to $1 million, which is what they would supply. So my warning is this. Yeah, somebody may raise their hand, or you may get something in the mail. I get letters all the time from non-admitted carriers saying, listen, we know that you're stuck with homeowners. Would you, before they can even get that out, I just fire them back and say, listen, not interested in a non-admitted carrier. A non-admitted carrier is somebody I will caution you not to take a look at. Not to take a look at. And I'm going to tell you where you need to go in just a second. The CIGA thing, why it's important, the California Insurance Guarantee Association, is because every one of those will automatically have somebody there to help handle that claim should something happen. The worst thing we can do for a shaky market already is, can you imagine? Let's imagine for a minute in Kinaloa Canyon, if you had about, I don't know, 5 or 6, 7 non-admitted carriers, Bradbury having non-admitted carriers. You imagine the damage that does to the California market, to have some people suddenly go out of business, they wanted to, and leave some people holding the bag? Wouldn't help us at all. All right. All right, next. Okay, so what are our options? The only option we have, the viable option we have right now, is California Fair Plan. We can close escrows with a California Fair Plan. All we need is just a fire policy to get to the escrow company. Now, I'll tell you, California Fair Plan is not a quick entity. They don't do things. I don't have any binding authority with California Fair Plan. We have to get information into them. I have to go out and take a look at the house the way I just did this morning. I took a look at the house, took a picture of it with the address on it. They want certain kinds of things. We send it in about a week, Candy? 5 to 7 business days. They'll come back with a quote, and then we'll be ready to close the escrow. Now, what does California Fair Plan cover? Well, they will cover personal property. They cover fair rental value, extended dwelling coverage, and all of the normal things, except they're very limited on perils. This is Lloyd's of London-esque kind of stuff. fire and lightning. That's the way, basic standard fire policy started. So they cover fire and lightning. Then the next thing they cover is called extended coverages. Extended coverages are perils like wind, hail, aircraft, riot, vehicles, explosions, smoke. Those are the extended coverage. And then they have vandalism and malicious mischief. That's another endorsement there. So that's all the coverage that you're going to get with a California fair plan. There's no liability. There's no burglary, no theft. There's no water damage. So why am I saying that? Because we're looking at the second thing that we would have to do in order to, get the coverage exactly right. We can close the escrow, granted, with a California fair plan, because the lender only cares about fire. But then we come back with what is called a difference in conditions policy. That's a Lloyd's of London type expression. We call it here a wraparound. The wraparound will simply provide coverages, basic coverages that the fair plan will not. It'll be burglary, theft, water damage, additional living expense, most of all, liability coverage. I had somebody in the Rotary meeting yesterday was, why wouldn't I self-insure my house? These premiums get so high, I'll just self-insure my house. I said, yeah, you can do that if you got enough money, but you can't self-insure liability because there are no limits to liability. You could have all kinds of personal injury things come up. Liability is the one thing you don't want to self-insure. If you want to self-insure your house, better go out and get a liability policy that takes care of personal injury, that kind of thing. All right, so California fair plan, here's the way it looks. Here's somebody we sent in a quote on, and we got it back very quickly. And then I've got access to a wraparound / DIC carrier that can give us the burglary, theft, water damage, liability, all the things. So basically what you got is two policies to make one. That's going to equal one homeowners. Only problem is it's expensive. It's going to cost twice as much as the homeowners did, but you can close the escrow. You don't have to have the wraparound or the DIC as part of as part of an impound account, because they don't really care. They only care about the fire. So you could have a California fair plan as part of the impound account and the wraparound. Anybody buying a fair plan from through my agency, I would say, don't ever overlook the DIC or the wraparound, because you got to have it. I'm most concerned about liability. Yeah, burglary and theft. Yeah, bit concerned about that, but liability is a biggie. You wind up with a personal injury lawsuit, then we're all in trouble. You're in trouble anyway. You're gonna lose everything based on a personal injury lawsuit. Burglary, you can only lose so much if you wanted to skip over that, but you don't. So go back. Can you go back to California fair plan for a minute? So all I'm gonna say is, once they come in with this premium, then either the insured could pay for the premium and present a paid receipt, for escrow, or you could have that premium, in this case, $2,634, as part of the escrow closing, right? And they have to, and if you then the following year when it comes up, they have terms. Can you show those terms? So you could go a 2 payment or 3 payment option. You can see right up there. If you needed to do that, but initial escrow closing, of course, everything's got to be in. But the next year, you don't have to turn around and pay that $2,600 all at once, because you remember you're going to have
3 installments. 3 installments.
3 installments. You can have 3 installments. So you're going to turn around and have a wraparound policy. Let's go to that. Wraparound policy is almost expensive as a California fair plan. It's $2,200, which is why I say we in the area where you're just going to be paying more for insurance. And so the wraparound policy is something you can take care of on your own. You know, you can set up payment plans and whatever you want to do with that. But we can close the escrow with the California Fair Plan. That's it. Now, Sue, let's say you had somebody signed a contract today, then whoever your insurance agent's going to be, call them right then and there. Don't let the ink even dry on the contract before you get in touch with an insurance agent, because California Fair Plan takes 5 to 7 business days. Sometimes they do it sooner, but most times not. All right.
No, that's just for the quote.
What's that?
That's just for the quote.
That's just for the quote. Yeah. So we get the quote back, and then we can ask them to bind it, you know, at that stage. They'll bind it at that stage. In order for me and us to get a wraparound policy, a DIC, we have to have the California Fair Plan quote. So this is a whole different way of doing business. You know, before, if you just, all you had to do was call my office or somebody else's office and say, can we bind this? And I would likely say yes. I don't have any binding authority with California Fair Plan. I just don't. I got to play by their rules. We've got to do by their rules, which means that we have to allow time. All right. Go ahead. Okay, so we get now to the most important session, question and answer. So I know I've covered a lot. I hope I've established why we're in the situation we're in. I hope I'm going to keep working on this. I've got a lot of contacts. I'm just going to keep working and try to help us. Every time there's a meeting that involves the Department of Insurance, you better believe I'm going to be in on it, because we need a lot of voices to keep saying the same thing. So it's not hearsay on the part of Commissioner Lara. It's not hearsay coming from just maybe once in a while a different voice. I'm just saying, and when I talk to other agents and brokers, I said, listen, we gotta band together on this. And I say to you, we have to band together. I have to band together with you guys to be able to be sure that we can get an escrow closed, because if we don't, everything starts to collapse, right? All right, question and answers.
Ooh, that was a lot.
Yeah, I'm afraid it wasn't.
I have a question.
Uh-huh.
Is there other policies? Is there like was that just like a basic policy? Is there a higher policy that you can?
On the California Fair Plan?
Yes.
There's some additional coverages you can add. So I just kind of gave you the basic policy, but you're probably not going to need much more than that. The rest of the coverage is really going to come from that DIC, that wraparound that I was talking about.
Okay.
Wraparound, listen, DICs are really broad in nature. You know, I just mentioned the basics because we usually look at liability. That's all right. Liability, burglary, theft, water damage. Those are the basic. We're looking at the things that happen most often. You're either going to have a small kitchen fire, or you're going to have a pipe rupture, that kind of thing. So a lot of it is that, but either going to have a small kitchen fire, or you're going to have a major fire in a brush area. That answer your question, I think?
Yeah. What about earthquake insurance?
That's CEA,
Okay.
California Earthquake Authority.
Okay, that's separate.
Yeah.
Now, can the insurance that we get, can it be impounded into?
Absolutely.
Okay.
You can have an impound. You can have anything you want. And here's what else. Let me mention this before I forget. If I'm writing a California Fair Plan plus a wraparound, we'll have a list of them going. The minute State Farm says we're going to resume writing again, guess what? We're attacking that list, and we're converting every one of those things to a regular homeowner. Just like that. You won't sit there with a fair plan because you're paying too much money. What do we have? 26 plus 22. What is that? 4,800? That's a lot of money. Those are Florida type premiums, really. But it's a stopgap right now so that we can close escrows, get ourselves through. And I got to tell you that the California economy is so important that this is in front of a lot of people. There are a lot of people who are sitting and waiting and contributing to try to help solve this problem. I got a Band-Aid. This is a Band-Aid. And I'm hoping it doesn't last more than a year or so. Because I want to be telling people, yeah, we're going right back. When your policy comes up for renewal, we're going to be writing regular homeowners is going to cut the premium in half. That's what we want to do. More questions? Yes, sir.
Question.
Yeah.
I could tell, thank you for I could tell you're passionate about your business industry. So, from the tone and all the knowledge and industry stuff, that to me is, I'm just tremendously impressed.
Thank you.
What kind, Costco insurance, are those not admitted carriers or are those admitted? I'm sorry.
Well, what, the California Fair Plan?
I don't know, it's people are telling me Costco is offering.
Oh, Costco.
Costco's actually one of the producers that has pulled out of the market as well. They're
Yeah, they pulled out. Yeah, they had, well, there's an association of carriers. Some of them were not admitted though. But they had some that were admitted, but they were just too small. There's no way they could stay in the market. Just no way.
So the way I'm hearing it is California Fair Plan is the last resort if we can't find anywhere else.
Absolutely.
California
Absolutely.
Right now in this period of time.
In this period of time, this is what we have and this is the solution. There really is nothing else. And as soon as, and of course, I got my ear to the ground all the time. I'm going to know something as soon as I'm going to have an advance warning probably on something as soon as it's going to happen, because I want to get us out of this mess. We got to get out of this mess. We can't stay here and have you tell your clients, yeah, this is the way it's going to be for a long time. But here's what you must tell them. Even if we get through this, expect to pay higher premiums. Because once again, I said, we're below the national average. So premiums are going to go up. You might as well start to warn your clients about it. Of course, if you got somebody moving in from another state, they probably already realize it. They're probably sitting there saying, I'm talking about months ago now, they were probably sitting there saying, gosh, I thought insurance premiums would be higher than that in California. And they're happy. But you got to warn them. You got to get them ready and say, I mean, look, we have wildfires. We have a lot of beautiful things in this state. We have oceans. We have views. We have views in Duarte Mesa. We have views in Bradbury. We have views in Arcadia Heights. We have views in other places, Kanaloa Canyon. Well, there's a cost. Everybody knows that there's a cost for living in places like that. You got a brush exposure, you got a view. Yeah, you're just going to pay money. You got to pay more money for that. That's it. Yes, ma'am. Well, you can't call them directly. You'd have to come through me or some other agent.
Contact you too. It's like purchase insurance, the same thing, right?
Oh, absolutely. I'm a registered agent for the California Fair Plan.
Oh.
Right. So it's not, you don't have to worry about it. All you got to do is you just call my office and somebody like Candy and 6 or 7 others will take care of it just like that.
The fire zone is still the 10%.
What's that?
Fire zone.
Even
If the-
it doesn't matter where it is. See, California Fair Plan was set up to take care of fire zones. There's no point in me trying to give you the history of California Fair Plan. It started back in the 60s. And believe it or not, it started with the Watts riots, which you probably know nothing about. A couple of people in here would, right? You would know something about that. So no insurance companies would go into Watts after the Watts riots and insure anything. So they developed California Fair Plan for that. California Fair Plan evolved into the entity now that it is to take care of really large homes in tough areas, right? In brush areas. So it evolved into that. More
So you
questions?
feel in like 3-5 years, something like that, you think State Farm will come back
Well, I think we'll come back before that.
before that?
Yeah.
Oh, this is some temporary.
I think so. But we got to define temporary. Some people ask me, do you think State Farm will come back? And I mean, we're still here. We're not, we didn't do anything with our existing clients.
Yeah.
We're still here. We're just not writing new business. And so I want to make that perfectly clear. No, we're not pulling out. And farmers hadn't yet, by the way. They're just not writing new business, So let's be clear on that. The insurance companies are still here. We just got to get create a situation where they can comfortably come back in. And Calvin, you know what I'd really like to see? I'd really like to see, now this may hurt for a while because insurance premiums would go up, but I would like to see a free market, instead of trying to hold them down with regulations. We saw that didn't work in Florida. Instead of trying to hold them down with regulations, allow the rates to go up high enough so that the insurance companies think they can make money. And once they get in there and they say, okay, yeah, then it becomes a free for all. Well, I guess what? Competition will naturally bring those rates back down. That's what I would like to see. I would like to see that better than, controlled rates.
I agree. 'Cause every insurance company or investor, they should know and analyze and have their own risks
Right,
and be able to.
Right.
If they calculate their own risks, then they lose their money.
they lose their money. If their rate's not high enough, then they lose their money. If their rate is too high, they're gonna lose business. I like that. I like a competitive market. Then I can talk about why what I offer or what we offer is better than somebody else. Yes, ma'am.
So right now, for the new customer, you only recommend the wealth plan.
California, that's all they can get right now. It'll close the escrow.
Okay, but the premium is high.
Premium's high, and we can get you that premium quote in a week. All you gotta do is call and let us know.
How much higher than the regular?
3 times.
Yeah, probably 2 or 3 times higher. Yeah. 2 or 3 times than a regular homeowner.
Or the one is like full insurance. Do you know that?
Yeah, I'm afraid I do. Yeah, I'm afraid I do. I think they're not admitted carrier. Oh.
But the non-admitted side.
Mhm.
I see.
Yeah.
Yeah, I think so, because that rate is low and.
Yeah, well, if it's too good to be true.
Yeah.
All right. Huh? Yeah, give her a card, please. Oh, she's got a card. More questions?
Any questions back here with the 3 ladies? Do you have any questions about it? No.
Who's the handsome man on here?
I don't know. I think I used to recognize him, but maybe I need to update that picture. All right.
Let's get Sam a big round of applause.
Thank you so much.
You're welcome.
Lots of information.
Great information.
Great information.